Hello everyone, today's video is all about personal pension contributions and how they can save income tax. So I've done a separate video on corporate pension contributions where you make a contribution from your company into your pension fund to save on corporation tax. But this is all about income tax, what I'm going to talk about today. So specifically as a tax planning tool, pensions are really good. They are one of the best ways that you can save a few quid on your income tax bill. Specifically, if you are a higher earner, and if you are earning in excess of six figures, you will be effectively paying 60% tax on the amount that you earn between £100,000 and £125,000. Why is it 60%? It's 60% because your personal allowance starts to be clawed back once you exceed earnings of 100,000. Personal allowance that every man, woman and child has, 12,500 this current tax year. That gets clawed back once you earn over 100 grand. Gets clawed back £1 for every £2 of earnings above that. So by the time you earn £125,000, you have zero personal allowance. That means that on that slice of earnings between 100 and 125, you are in effect paying tax at 60%. So how do you get out of that 60% tax band? Well, one of the best ways to do it is to pay a pension. So if you pay a pension that is £25,000, that will bring what's known as your adjusted income down to £100,000, and your personal allowance will be reinstated. So in actual fact, that pension contribution, 25,000, is what we call a gross contribution. So in terms of writing a check to your pension fund, you'd only actually pay across 20,000. 20,000 is what we call grossed up, which means that HMRC contribute another 20% of that to your pension fund, which means that the 20% of the gross amount, 25%, £5,000, HMRC write a check to your pension provider. So you contribute a cash sum of 20 grand, HMRC add 5,000 on top of that, 25 grand lands in your pension fund, but specifically as far as your tax is concerned and your tax return, your adjusted net income goes from 125 down to 100, and the actual amount of income tax that you would pay is reduced by 10 grand. You'd pay 10 grand less income tax because of that, and you've also been given an extra 5,000 contribution from the government. So consider that as tax relief as well, that extra 5 grand that they top up your pension fund. So the 10 grand saving on your tax bill combined with a 5 grand extra top up to your pension given by HMRC, that is a combined saving of 15,000. 15,000 on the gross 25,000 pension contribution, that is 60% effective rate. So it's 60% saving that you've got from making that contribution. So do think about making individual pension contributions, particularly if you have earnings just over 100,000, because if you do, that is one way, it's the main way actually, to get your personal allowance reinstated and get out of that dreaded 60% tax bracket. Now, for thousands of people right now, where are we? We're at the 19th of January. Tax return deadline is looming, which means an awful lot of people are going to write checks. Checks is a bit old school. Wire transfer in the next few days to settle their 1920 tax liability. Now, for pensions, in terms of the tax planning, it has to be done in what we call real time. So it's too late to do anything about last year's tax bill that needs to be settled right now. However, remember that January 31st is also when HMRC want the first instalment of next year's tax. Next year being the tax year that we're in right now, the 2021 tax year. So it's a potential double whammy is the 31st of Jan. It's the balance for the tax of the previous year plus the first half of this year. So whilst pension contributions right now can't do anything about the balance of the previous year, what they certainly can do is reduce the tax for the current year that we're in, which means that you can reduce the payment on account that HMRC are expecting from you right now. So in terms of how much you've got to pay over to the taxman now, if you make a pension contribution now, that will certainly reduce the amount that you have to pay HMRC, principally on the first instalment of this year's. Can't do anything about last year's, but going forward, it's worthwhile getting into a routine of making pension contributions in the tax year, specifically no later than the 5th of April each tax year, when you see you've had the whole hindsight of 12 months to see what your earnings are. And if you are over some of these trigger points, like 100,000, get a pension contribution made personally and save big chunks on your tax bill. 60% is a big saving of tax. So that's just an overview of individual pension contributions. Please do think about making them right now, but all is not lost if you don't. The crucial thing is to get them in before the 5th of April. However, to reduce your payment on account that's due at the end of January, it certainly would help if you make that contribution now. So if you like this video, please do subscribe there, and I will see you soon.